you're going to go make this investment. Why don't we strip money out of this, move it over here and invest it? And then there's some tax deductibility on that as well.
Yeah.
Right? So it's like those things are important, right? Knowing when to own something in a corporation and when not. When is this tax deductible? When is it not? That stuff's really going to drive long-term value.
It's short-term pain for your gain, long-term gain. You're going to be paying extra. You're going to be dealing with the headache of the bank accounts and all this stuff. But if something goes wrong, or when you go like for your tax advantage in the future, like that's when you're like, it was all worth it.
Welcome back to REI Hot Seat. We've got Dave and Brad here for yet another episode. And today we're just doing a nuts and bolts episode on corporation versus no corporation. Should you do it? None of us are accountants. We're not lawyers. We're not giving you advice. We're just giving you what we've heard and know and experienced in our career.
We're like chimps with machine guns here. Yeah. We're like, kind of know a little bit dangerous. So let's go for it, boys.
I've never, that's amazing. I'm going to use that now.
Yeah. All right. So, going way back, I mean, I bought stuff personally and then sort of regretted it because one of the main implications to buying a whole bunch of stuff personally, especially on the res side, is you affect your ability to get mortgages for your personal home. I believe a lot of underwriters on the res side, because of their inexperience and coming from a mortgage brokering background, they don't get it. They see a mortgage in your name, you tell them you own an 8-plex, they don't care that it's commercial. They're probably going to try and apply it against your ratios, and it's going to affect you. Some of them do get it and actually will eliminate it, but you're taking some risks there. Yeah. So that, I mean, on the non-tax side of things, is a great reason to put your multifams in a corp. Like, sure, you can have the odd rental property in your name. Even then, you might not want to. For the same reasons, right? Because now when you go to the bank and you try and get approved, they're now building in, okay, we're going to factor 50% of your rental income on that rental property and 100% of your mortgage. Okay, well, now I don't qualify for as much. So that's the problem. But anyway, so I gave one look at it. Why don't you guys, Dave, you want to give your perspective?
Well, yeah, and I'll circle back. So we got this question comes from a few of the intake calls we did for the Insider. And it was particular to, hey, if I want to own it in a corporation, because one of them is thinking about offering, what do we do? Because they don't have the corp. So do you want me to go set it up?
Yeah.
And so the answer for that is you don't need to set it up yet. So we put in the APS a clause that will allow you to sign it to a corporation that you create. So, nothing would be worse. You go, you open a corporation, and you don't do the deal.
Yeah.
Right? So we go through the due diligence period. You get close, you're going to firm up. We open the corporation, or even before you close, and transfer it in. So you're okay that way.
Yeah, that's good to know, and it also is very quick to open up a corporation. I've literally done it online.
Yeah, it's super easy. So, but anyway, stepping back, kind of going to the benefits. I mean, one of the other ones is liability. So when you have a corporation, it's its own entity, and it's going to circumvent at least some of the liability as an owner. So the corporation is going to be the owner of the multifamily building, and it's not Brad and Dave.
Yeah. I mean, if you have a good liability policy, insurance-wise, you're protected to a degree.
You'd be surprised,
anyway.
though, sometimes. Like, insurance is a funny business. So before private wealth, I was in insurance, and it's, crazy to see some of the things. I mean, even on one of our multis, we had a flood from the second floor down into the main floor. And wouldn't you know it, insurance didn't cover it. And it's like, we're going through the particulars and you're just scratching your head, and they have these little outs every once in a while.
Yeah, they'll take them. They'll take them if they can, right?
So, I would imagine that if it was a grand scale liability, you see it often where insurance starts to posture and perhaps tries not to cover it. So anyways, not bagging on insurance too hard so I don't get sued into oblivion. But there are ways. So I understand what you're saying. I agree. Yeah. Insurance is a critical component to this picture, but it's another added layer of potential protection.
Yeah, that's true. It is an extra layer. I've long felt that it wasn't like the most important part, but you make a valid point.
Not, but it's certainly
you make a valid point.
Benefit. Yeah.
Yeah. Another one is just for raising capital or being able to get into a deal legally with multiple people with share issuance. So if you have a property, whether it's a holding company or it's the corporation that owns the property itself, you can divide that up in the future if you need. And you can do that without moving the property at all. You don't have to go through a sale. You don't have to do anything, or sale of the property, I should say. You can raise money
just issue
into the
shares.
Exactly.
Just issue shares. Yeah. Valid point. Okay. So now we swing around to the negatives. I mean, I would say, of course, like the positives wise, like organization, keeping things separate, doing a corporation per building. Like I was just talking to one of the accountants I work with. That's what he does. Every building he has gets its own corp. Lots of people do that. And, you know, the annoying part of that is you got bank accounts, you got extra access cards for every single one. You got an extra tax filing. You're paying the accountant again. There's a lot that goes on, and it is at a cost. So you have peace of mind, but at a cost.
Yes.
The negative to being in a corp, though, is the tax rate at surface value, which, you know, I'm going to preface this by saying my understanding from talking to my accountant is that as long as you pay yourself a dividend, you recapture some of the taxes paid. So effective rate comes down to like 20% tax rate in the corp, right? Otherwise, it's 50 if you don't pay yourself a dividend.
Yeah, you got to move it.
Yeah. So how do you get around that? You know, what I've done is capital cost allowance. We'll write off as much as we can. So if you have, you know, if you would have had like a $10,000 or $20,000 profit, you write off part of the value of the building to eliminate that. Yep. And I think in most people's cases, especially with, you know, cash flow not being monstrous like it used to be, you can usually make that work with the CCA. So that's been my experience. You know, non-accountant here, an ape with a machine gun, chimpanzee,
chimp with a machine gun.
That's it. I mean, I'm just giving my perspective, but I mean, I find these discussions like because. As somebody who's been in the business of like buying real estate, renovating real estate for like 12, 13 years now, I've always appreciated like an accountant that actually does it because they understand what the lawyers do. They understand. And those are the people I surrounded myself with all these years and had on my podcast so I could get these perspectives.
Yeah, well said, yes.
Yeah. And that's like guys like you guys, you understand the accounting side a bit, the legal side a bit enough for like the transactional stuff, which is really what I think most people need.
Even if like to step away from corps, even when you're trying to do a deal, you know, it's a plug for us obviously on this side because this is what we specialize in, but your mortgage broker, your lawyers, right? Like we had a guy that was closing on a mixed use property who was a lawyer that was a residential lawyer. And he was like, you absolutely are paying HST on this. And we're like, no. If he gets an HST number, it rolls through. Big debate, end up getting another lawyer's opinion, and he laughed. He's like, that guy obviously doesn't do this.
Doesn't do this,
and it's, you know, it's not to knock that individual, but it's not their specialty.
Mm-hmm. Yeah.
And so finding an accountant that actually knows it, if they own multis, even better, right?
Yeah.
But they don't have to, as long as there's seasoned.
Yeah.
I don't know if you guys find it, but a lot of the accountants that have been around for a long time have some involvement.
They own real estate.
In real estate.
Well, but if you ask them, any one of them, what's the number one most common thing you see among your wealthiest clients? They're going to say real estate.
So I used to do private wealth, and that was bar none the whole thing that transpired to all of them. They all owned many pieces of real estate, and they held it for the long term.
It was I was at a it's called a business seminar. I don't know if I'm actually supposed to share the information, so I won't say the name of it. This past year, where they have a large private, like a family office that they run personally, and they actually showed us the division of the assets within their wealth management, and real estate was 47%.
Wow.
And I looked at this and I'm thinking, like, I thought you owned companies and you know, private equity, private debt, all of these things, and real estate was by far the largest. And they did an explanation, and real estate will continue to be the largest in it. Of course, they want to diversify and have other things, but that was kind of eye-opening to me. I was like, I thought once you get into that echelon of wealth, like real estate kind of lessons in what you own, but that was a big
and it could be like, I know some people are of the philosophy that, you know, you could just do the safe withdrawal amount, so you can build a big portfolio of stocks, you can withdraw 4% a year, and that should be fine. So I think there's been a certain crew of people that buy real estate to get to that level and then liquidate some. And I know a friend of mine like did exactly that, made millions in real estate and then made millions and millions and millions in stocks. And you know, kind of shifted gears. So everyone will find their own path, I think.
Exactly.
But
I think a key is a nice solid diversification. But if we go to Warren Buffett, not over diversifying.
Yeah,
I think one of his sayings was diversification is a tax for the stupid. It's paraphrasing.
Yep.
The idea is like what you know well, and you kind of stick to that and go heavy into it.
Yeah.
So.
Yeah, that's well said. I've never heard that quote, but
I butchered it. But that's my chimp with a machine gun paraphrase. But that was this was a little softer. But that was the idea.
The exact same event that I was at. They said that you should not do, like, this is stocks in particular. Until you have $100,000, don't pick your own stocks, because you're 9 times out of 10 you're not going to beat the market, the S&P 500 or anything like that. And he's like, once you get to $1 million in investments, that's when you can kind of start to pick in between. But like, you should have one thing until you have $1 million invested.
Like anything, right? Like, again, I used to do private wealth. You watch these guys, they want to do their day trading because they think it's a hot, fun thing to do. And if you really invest time in it, there's money to be made. It's not dissimilar from people that want a part-time real estate, and then they buy some decrepit building and realize it's not where they want to allocate their time. To most people, the better thing to do is, a nice quality ETF or a managed money. And same as, these hybrid blends that we talk about, sending it to CMHC, cash flowing positive, and pick away at it at a time. You're saving yourself from having to put all your resources into being your time, right?
A lot of this is about knowing yourself, though, right? Like, if you know your time commitments and your level of interest, you won't make that mistake. But a lot of times, especially when people are earlier on and they're, they don't like their current job or whatever, and they want a way out, they might just make an impulsive decision and get into something that they shouldn't, or they're sitting on a bunch of money they saved and don't know what to do with it, and they kind of make an impulsive, we better do this.
We do a lot of the intake calls. We talk about like portfolio optimization, for a little bit of a buzzword, but you bought 4 new construction condos and you made a lot of money on all of them, and they're cash flowing neutral, and a lot of them just hang on because that's what they've done. And you look at it and say, hey, you've got $200,000 in each one of these. Is that the best use for that equity, or could we do something else?
Yeah.
And obviously we go through the focus of multifamily, but even stripping some of that out and throwing it into an ETF or something else, but sitting in this condo, earning nothing, doing nothing, is that the best use? And what we've done is engage with mortgage brokers that we trust, and groups of them, not just one, and saying, hey, look at their portfolio. Because the real estate agent's always going to tell you to sell, right? And the surgeon's always going to tell you to cut. But having somebody like that who's going to look at it through the refinance lens, who's being objective and say, hey, that condo, this particular one, let's go get it valued and we might want to sell it. And we've been doing really good work with, optimizing the portfolios and taking some of that and moving it into multis and watching cash flow start to actually kick off.
Yeah. Yeah, it's definitely works to be introspective. One of the things that you can actually look up on your properties and your companies is return on equity. How much equity do you have in your property? Because everybody looks at return on investment, but really what's more important in the longer run, especially for optimization, is return on equity. Yes. How much, if you're sitting on $1 million building with a $100,000 mortgage, you might be making great cash flow, but have you looked at your return on equity? And some people, they don't want to lever and whatever. They don't want to get the debt. I can understand that. But it's good to be informed about the impact of that.
Choices, right? Like we used to do that back in the day too, and saying, hey, you have your house is debt free, and you're going to go make this investment. Why don't we strip money out of this, move it over here and invest it? And then there's some tax deductibility on that as well.
Yeah.
Right? So it's like those things are important, right? Knowing when to own something in a corporation and when not. When is this tax deductible? When is it not? That stuff's really going to drive long-term value.
Yeah. It's tax deductible if it was used for an investment, right?
Correct. Yeah.
Yeah. Not accountants.
Not accountants. Also, yeah.
And not to plug us as agents, where there's more agents that do this, but as you just mentioned, Dave, like we're not hey, come to us so you can sell and buy more. It's how can you use your money? And it's really going through and just taking time to understand your portfolio of, just echoing what you say of like, and maybe the best use of the portfolio isn't what you want to do either. We're in the in the business of helping you do what you want to do with your money. And if at the end of the day you don't want to maximize the use, perfect. Like we're here to help make sure that you're just comfortable with what you have, what you want to buy, everything there. Yeah,
some people they got no debt on they got apartment buildings paid off, and that's comfortable. Hey, I get it. That makes sense. But yeah, some people, if you're in a more aggressive growth phase, you're gonna want to be borrowing against that and going to the next level.
I used to have clients, a husband, wife, and incredibly risk adverse. Like just kept them up at night, and they would always try to push towards, heavily deployed, like moving a lot more into equities, and you'd have these conversations, you'd circle back and help them understand, right? And then, you'd caution them and they wouldn't do it. And it's like they'd get hyped and read something and want to deploy a bunch more money to the markets, but they're just so risk adverse. And understanding them or understanding yourself and where you actually want, like if you're going to make those returns for them, just as a key, they didn't need to risk more. They were more than enough for what they needed. So it was like, what are we fighting for here exactly? Like, why are you doing this? And helping them understand you're gonna hit your goals, just stay the path, right? So understanding like not just what your risk tolerance is, but why you want to do what you want to do, and pair those together.
Yeah. Yep. Well said.
And so our 5 minutes of corporations and 10 minutes of talking about utilization of the profit or utilization of your money.
Well, they tie in, right?
Of course.
Obviously, like even like tax planning and wealth planning, they all kind of tie together. And the corporate decision is a tax planning decision, but it's also a liability planning decision and a wealth planning decision, because realistically, I don't know of anybody anymore that's growing their portfolio of multifamily buildings in their personal name.
No.
That's
so I pulled a list of just yesterday randomly over 10 units, but less than 50. Okay, so 10 to 50 units in Ontario, not owned in a corporation, and I think there was 700 total across all of.
So pretty uncommon. And those are all the old Italian guy that's owned it for, owned it for 40 years.
100%. Yeah. 100%. So
still cuts his own grass.
Again, it's like, it doesn't mean that's wrong, but a lot of times it was buying a multifamily for $150,000 in a way. Right?
Just a different time.
Yeah.
Different time. And there's maybe mitigating reasons. I honestly can't think of why you wouldn't, other than what you talked about, right? So there's the setup. It is annoying. Like, I own several buildings. It is frustrating. I have bank accounts, to your point. I got to do annual taxes.
Can't stand having more.
It's very annoying. It sounds like it's not, but then you start doing it. Mine's minor in comparison. Some people have many, many, many of them.
Yeah, but you're like $5,000. I mean, like I'm $3,000 a year to the accountant on one company. So, and that's if I don't do anything special and extra. Yeah. So what about, you add more and more. It's like, but if you're making tons of money off of what you're doing, you kind of just look at, hey, it's part of the business. Yeah. And as long as the asset you're buying covers all that, you just build that into your numbers and you feel good about it.
Well said.
My thing with that is like, it's short-term pain for your gain, long-term gain. You're going to be paying extra. You're going to be dealing with the headache of the bank accounts and all this stuff. But if something goes wrong, or when you go like for your tax advantage in the future, like that's when you're like, it was all worth it. Yeah. Like I now realize why I was putting myself through that.
One of the biggest things is just working with the lenders, right? Yeah. If you want to refinance eventually, it's just way cleaner.
Yeah.
Everything's there, nice and clean. So anyways, that's a nice bow on this. I think the general sentiment is, I mean, it depends on how serious you are, but I think most people, if you're buying a multi, you're going on a corp. If you're just getting started and it's your first, if it's a single family or whatever, I could see an argument for doing that in your own name. I've certainly done it. And anything else to add before we wrap up, guys?
Just to reiterate, you're not necessarily going to need to do that while we're entering into offering. So we can do that at a later time. So you're not rushed. If you don't have it, all good.
Corps can be set up extremely quickly. Not something that needs to be done ahead of time.
And as always, just do your own due diligence. Know what's best for you in your situation. Talk to your accountant, whatever it is. Just don't take someone else's advice if it's not best for you.
Yeah. And the last thing here, we're never going to get off because we're so excited.
One more last thing.
PPS. But trying, if you can, to get all your experts to work together. So what happens sometimes is they work in silos. So your accountant's over here, your lawyer's over here, your broker's over here, and nobody's really working together. If you can get them to connect, you'd be amazed at how fast and far you can get.
I never do telephone game anymore. I used to. I just say, oh, that sounds like a pretty complex thing. How about I just connect you with the accountant?
It's beautiful.
Lawyer, here's accountant. I'm not involved in this anymore.
I will butcher
it. It's the game of operator, right? You're in the middle, and you're giving half the information that you retained over to the accountant. It's a problem. Yeah. So pay the cost, connect them, be on the call. That would be my recommendation.
Or get CC'd on the emails.
Yeah. I find calls are way faster, and just be a fly on the wall and get them to connect. But separating them is where things slow down, and it's not that complex. So.
All right, well said. Okay, guys, if you made it this far, show the channel some love for us. Big thumbs up for us, and share this video with somebody you think it might help. And then, of course, if you want to be an insider, REI Hot Seat insiders get access to all kinds of cool things, including off-market listings, a conversation with Dave or somebody on the team, maybe Brad, and you'll also have access to a cash flow spreadsheet, I'm told.
Yes,
which I might have had a hand in creating.
You may have created, and then
1 or 2 years ago.
Version 1 was you. Yeah. So we have gotten some comments and questions around getting the sheet that we use in on the podcast here. So that sheet we keep to ourselves. There's a lot of different formulas, but we do have a version that's actually often used by the underwriters. So we have that. So if you sign up, you'll have a copy of it.
Yep. Perfect. Okay, and the link is under this video if you're on YouTube. If you're on any of the podcast platforms, it's going to be in your show notes. Thanks. We will see you again next week.